The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to today's webcast on the new FLSA regulations effective December 1st, 2016. This webcast is a continuation of our webcast series to keep you informed of current HR topics and the impact it has on your business. As always, today's webcast is brought to you by our PEO division, including Employer Solutions Group, Professional Staff Management, and Century 2. My name is David Kyle, and it's my pleasure serving you as one of your presenters today. Also presenting today will be Kim Troop, also from Century 2. Now, before we get started, I do want to cover a couple of items. At the conclusion of today's webcast, all participants will be emailed a copy of today's presentation. We will take questions at the end of the presentation, but all participants will be muted, so you'll need to use the function to ask questions. Now, moving along to our session, Kim will give us a refresher on the current FLSA regs. I will then discuss what is changing as of December 1st.
Thanks, David, and I appreciate everybody joining us today. Obviously, this is a significant change that's happening effective December 1st, and it really is going to impact really every business, essentially. So I think it makes sense to initially just talk a little bit about, Dave, can help, just quickly talk about the FLSA regs and what they are. Essentially, FLSA is the Fair Labor Standards Act. And that particular statute is a federal statute, and that covers things like overtime. It talks about minimum wage, some of our child labor laws, and talks about the Equal Pay Act. This is a federal statute, and there are a lot of states that have additional rules, such as some states have minimum wage rules that are higher than the federal statute. Other states, like California, have additional provisions about when someone is eligible for overtime, such as in California, you actually get overtime for hours worked over 8 in a day. So it's important when we talk about FLSA and you think about employees in the states that you're dealing with, that you have to think not only about the federal statutes, but any state-specific statutes that may be applicable to them as well. So the key provisions in the new FLSA rules that are going to go into place effective December 1st is the new provisions provide a new minimum standard salary level for any employee that meets the duties test and the salary basis test, and thus is eligible to be exempt from overtime. And we'll talk about a little more about what that means. There's also an additional exemption called the highly compensated exemption, which we'll discuss a little further. And the new regulations define a higher minimum salary level for that particular exemption. In the new statute, it also establishes a mechanism where there's automatic updates to the minimum salary level and the highly compensated salary level that happens every 3 years. So we won't see any change in that after December 1st until 2020. Additionally, for that minimum salary standard level, there is a provision that allows non-discretionary bonuses to satisfy up to 10% of that minimum weekly salary for exempt employees. And we'll talk a little bit more about what that means shortly. So just talk about some real fundamental definitions. So exempt versus non-exempt. So a non-exempt position defined in FLSA is an individual who is entitled to overtime pay, meaning from the federal perspective, they're entitled to overtime for any hours worked in excess of 40 in a week. Exempt is the definition of an employee who satisfies the we're going to talk about in a minute, and they are not subject to overtime pay. So those individuals do not get paid overtime when they work in excess of 40 hours in a week. Now, one distinction that I think often people confuse is the language, the terminology of exempt and salaried. And those two concepts are very different concepts. Under FLSA, you have someone who's either non-exempt and they are subject to overtime, or they're exempt, not subject to overtime. salary is a different concept, and we'll talk about that a little later in the presentation, but I want to make sure that you don't synonymously use both exempt and salaried in the same way, because they are two very different things. So again, I'm just going to quickly hit the white-collar exemptions. These are the tests that have to be satisfied in order for someone to be exempt, not subject to overtime. We're going to hit these fairly quickly, but before I start, let me just stop and say I think that the FLSA and the exemption test, the duties test, are probably one of the more complicated things that employers run afoul as they're trying to classify employees. And this is a perfect time for all employers to clean up positions that maybe are questionable, or maybe they're not even classified correctly right now. So it is really important that you do understand the distinctions and the differences related to the white-collar exemptions. So essentially, you have an executive exemption, you have an administrative, a professional, the highly compensated, you've got a highly skilled computer exemption, and then you have outside sales. And we're just going to quickly hit on, touch upon those concepts which have not changed except for the salary level, the highly compensated. These particular exemptions, these duty tests, they are not changing with the new regulations effective December 1st. All right, so let's talk about, so there's essentially 3 tests that have to be satisfied in order to qualify to be an exempt employee. So the first thing is that individual, that employee, has to be paid a fixed amount, a salary, if you will, on a weekly basis that's not subject to reductions due to the quality or the quantity of work. So they receive the same pay every week, irrespective of the fact that they worked 60 hours that week, or maybe they only worked 39 hours that week. Effective now for December 1st, there'll be a new minimum salary, and all exempt employees will have to be paid at least $913 a week, which is $47,476 annually. That's a pretty big change, and that ends up impacting a lot of employers. Currently, what we had in place was $455 a week, and essentially you only had to make $23,000, and if you pass the other 2 tests, you could be qualified as an exempt employee. So a lot of companies will have to look at salary levels and may have to make some adjustments accordingly. The third test, and again, all 3 of these tests have to be passed, not 1 or 2 of them, but all 3. The employee's primary job duty has to involve the kind of work associated with either the executive, the administrative, or the professional duties test. And we'll talk shortly just what those things are. So briefly, going back to that first test, so the first thing that has to happen, that exempt employees' pay cannot be docked any week except for a very narrow window, a very narrow set of circumstances. It is permissible for you, if you have a sick and vacation policy in place, for you to dock the hours of somebody and offset and use sick and vacation pay, but you can't do partial day deductions for an exempt employee. If you do those, you end up losing your exempt status. So that's an important thing to make sure when you have exempt employees. They essentially are paid that fixed week. When they perform work on any day, they are paid. So even if they kick out at 3 o'clock on the afternoon, they're still paid for the day of work. So that minimum salary, again, is now increasing to $913 a week. Well, what's included in the minimum salary? Well, essentially, it includes all their regular pay, overtime pay, includes non-discretionary bonuses, but what it doesn't include things like if you are providing housing, maybe you're doing taxable fringe benefits to an employee. Those don't count towards the $913 a week. Contributions towards benefits don't count towards that. And discretionary bonuses are also not included in that $913 a week. The new provision in the regulations effective December 1st, again, do allow for 10% of the individual salary to include things such as commissions and non-discretionary bonuses. And just to be clear, a non-discretionary bonus would mean those are things that are established on the front end, and they have criteria that are attached to that. So maybe they're performance related or they're productivity related, but there's a defined set of circumstances where the employee understands if I meet these criteria, I'm going to be paid a bonus. That's different than a purely discretionary bonus, which maybe sometimes employers do at the end of the year. Maybe they do a Christmas bonus where they look back and they do a calculation, how is our productivity or our profit for the year? Okay, it was good, let's do a bonus for employees. That would be a discretionary bonus, and that would not be included in that minimum salary $913 a week provision. So now what happens is you can use 10% of the wages can be paid on a quarterly basis for non-discretionary bonuses, but they have to happen on a quarterly basis. You can't wait and just do that once a year and go, oops, we were a little bit behind, it's $47,000, let's make that up and pay them. You actually have to make sure that equivalent of the $913 is happening on a quarterly basis for $913 a week on a quarterly basis for any exempt employee that meets the other tests. One thing to note, the salary level and the salary basis test, those things don't apply to outside sales employees. They don't apply to doctors, lawyers, and teachers, and they also don't apply to some of the computer-related exemptions, which we'll talk quickly about just in a moment as well. All right, so we talked about already the new provisions have an automatic update that happens every 3 years, and there'll be a calculation that's either a fixed percentile of wages and probably based on the consumer price index. So our next increase for that minimum salary will not happen January 1st of 2020. So until that time, that threshold for an exempt employee, that minimum salary will be $913 a week. Equally as important, the third prong of determining exempt employee status is the duties test. And this is probably where we always get this is where we get the most confused about who really qualifies under the duties test. I think the thing, again, these tests are not changing. One thing that's important to know, a job title, that's not sufficient. So just because we call someone, a director, or we call them a VP, if they're not really performing sufficient duties to qualify for the exempt status, the job title is really irrelevant. So I think that's important to make sure that's not a workaround, is just giving them a different title. And I think the most important thing to understand, if it's somewhat unclear whether the individual really fits into an exemption, the safest thing to do is to make sure that you're paying the employee on an hourly basis, paying them non-exempt. That reduces your overall liability for a wage and hour claim. And again, wage and hour claims can get extremely expensive, and those are things that are not covered by your employer practices liability policy. So it's important to get that right. And if you're going to err on the side of caution and be conservative in those determinations. So I think the executive exemption, that's probably pretty clear. We all get that. We understand the executive exemption. Essentially, these are the top executives of the company. They're directing the work of 2 or more full-time employees, and they have the authority to hire and fire employees. And I think for the most part, we don't have trouble determining who fits the exemption, executive exemption status. Probably where there's the most problem in making sure that we get it correct is in the administrative exemption. And those individuals have to have a primary duty that's non-manual, non-office work that's related to the management or the general operation of the business. And the most important part is they have to exercise discretion and independent judgment in carrying out their position. So someone who has a very defined set of policies and procedures likely may not be using discretion and independent judgment carrying out their responsibilities. Again, they have to be directly involved with running the business. These are not individuals who are likely working on the manufacturing line. They're not selling products in a retail establishment. Those are probably things that are not going to qualify for the administrative exemption. I think the professional exemption position is exemption again. That's probably pretty clear as well. There's essentially three categories of that professional exemption. The first one is the learned professional exemption, and those are individuals, these are like our doctors, our lawyers. These are people that are trained, have advanced knowledge in the field of science or learning, and they've had prolonged course, they've had specialized instruction. They predominantly, these are not things that you can attain at a high school level or maybe even at a certification level. These are really long studies, prolonged studies where people are attaining advanced knowledge. The other type of professional is a creative professional, and these are individuals who are using, maybe they're inventing, they're using their imagination, they have originality, they have talents that are artistic or creative. And these are individuals like musicians, writers, actors, graphic arts individuals. And again, these individuals are using creativity and not working from a script or defined set of responsibilities. And those individuals, lots of them will qualify for that creative professional exempt status. Teachers also are covered under that professional exemption, and again, are not subject to overtime. We talked a little bit ago about the highly compensated exemption. This is one that is changing effective for December 1st. As of right now, this is a shorter test, but for an employee that earned in excess of $100,000 a year, and their job primarily was performing one of the types of duties identified in those earlier exemptions that we discussed, those individuals, if they made over $100,000 in a year, those individuals were eligible for the highly compensated exemption. That's now changed to $134,000 a year versus the $100,000. Again, that 10% bonus, just like we talked about a little earlier, you can use non-discretionary bonuses or commissions to total the 10% of that pay. So that is one of the things that you would need to pay attention if you have highly compensated individuals that were qualified under that particular exemption. The last one is the skilled computer exemption. And again, I think this is fairly straightforward. The thing that you do need to keep in mind, these are not someone that's working a help desk, and this is not someone that's going out and doing computer repairs. Those specifically are not going to qualify under the skilled computer exemption. These are people that are doing software design and doing hardware, software consulting, and they're creating programs and apps. So that's the skilled computer exemption. And then the last that I think we're probably the most we're familiar with is just the outside sales exemption. And again, those individuals that qualify for that exemption, you know, they're outside of the office, they're making sales, getting contracts and services for the company. They're regularly engaged away from the employer's place of business. It's important to understand that inside salespeople are not the same as outside salespeople, and inside sales positions are non-exempt. They have to be paid overtime. So that's an important distinction when we talk about this is an outside sales exemption. So quickly, let's just talk about some of the things that you have to do to start being ready, to think about getting ready for the new regs that go into place. First of all, let me say that your HR team is prepared to help you walk through all the analysis to help you get ready for December 1. But these are some things that you need to start thinking about on the front end. first of all, we can help you identify the employees that you may need to reclassify. Part of that may just be individuals who don't meet that minimum salary threshold that will be effective December 1. One of the other things you have to think about and consider is what's the typical work schedule of those employees that are kind of on the bubble of whether or not they're exempt or non-exempt. Do they work a lot of additional hours over 40? And if they do, there's probably some more consideration, some more strategy in really looking at those positions and their responsibilities to make the best decision to be as helpful as possible to the company once the new regs go in place. Obviously, then you have to think about those the non-traditional work hours. We'll talk about that just in a second. And you have to think about the overall impact on the organization. These are some pretty big changes that we're talking about. So again, that first, first point that we talked about, you're going to have to identify all employees that are making less than that $9.13 a week that are currently treated as exempt and not paid overtime. Again, looking at the number of hours for positions. Probably the most challenging that we all have is thinking outside of the box. So it's not just the 8 to 5, 9 to 5 hours, but it's those weekend and after hours activities that happen that we need to consider because those, if we got somebody that's currently exempt that now will be non-exempt, those are things like travel time. Maybe we have employees that are logging in or they have email on their phone and they're checking emails outside of normal work hours. Maybe they're responding to issues or questions a customer has, outside of the work hours, or coming in on the weekends to help catch up projects. These are all things for a non-exempt employee that are compensable. And so when we now have to think about overtime payments, we really have to get our arms around the hours that we really have people working. And then we have to think about the impact of the organization. So a lot of people feel like I'm an exempt employee, and thus, there's some sense of status that goes along with that. I don't have to track my hours, I'm exempt. And what happens when suddenly the regs go in place and we now have to move them to a non-exempt status, and they do have to track their time? What about managers that are used to not having to monitor weekly schedules of these individuals that now have to think about that to try to manage the overtime? So these are some of the thorny questions that we have to consider on the front end in order to be ready for the changes as they come up December 1st. All right, and David's going to talk a little further about the changes that are coming up.
Thank you, Kim. So the good news is that we do have options as employers. All of the options may not be favorable, and the important thing is once we're preparing and we've done this getting ready steps, we can now determine maybe what's the best step for our individuals in our organization. So the 4 options that we're going to present today is you're able to raise the salary to keep the eligible employees exempt. You can reclassify the employee as a non-exempt employee and then pay them hourly. If we make this decision, then we have 2 options of what do we do with their rate. Do we increase the rate? Do we keep it the same? Do we decrease rate or do we keep it the same? We can also reclass the employee as a non-exempt and pay them salary. So going back a little bit, the distinction, salary, non-exempt can still be independent of one another. We can restructure the workflow to help limit and monitor overtime. And then we can use what's also called the fluctuating work week method. So the first option of raising the salary, keeping the employee exempt, this is again our best opportunity to review the exemptions, making sure that they are falling within the duties test. Now with this government regulation change, it gives us a great time to have a good reason to review all of our exempt employees and making sure that they do fall within the duties test. Once we're satisfied that they have actually met that, now we can increase the salary to the new salary-based test to the $19.13 a week. Now, factor in the typical weekly work hours scheduled in your decision. So what does this employee in this position typically work every week? And does the typical weekly work hours for overtime cost for the week? So outweighing the cost of moving the employee to the minimum salary. And then don't forget that every 3 years, this salary will index increase automatically. So any of your budgeting plans for certain 2020, there will be an automatic increase for any exempt salaried positions. And again, you might at that time have to make a decision whether you will increase the employee salary to the new index level, or will you then make the decision to one of these other options regarding their work week. Second option is we can reclassify them as an hourly employee, non-exempt. Two different options within that category is with the same rate of pay. So this same rate of pay would be great for the employee because from an hourly basis, it looks as though they're getting a raise. Because for the first 40 hours of that overtime, they're getting their straight pay, but then in the overtime, anything over the 40 hours that they work would be the time and a half. So in this example, an exempt employee works 45 hours. As an exempt employee, if they're $400 a week salary, that's how much they get paid for working the 45 hours. Now, if we decide to reclassify this employee as a non-exempt, and the employee continues to work the 45 hours per week as a non-exempt employee, the first 40 hours is $10 an hour, and then the time and a half $15 an hour rate for the remaining 5 hours of that 45-hour work week. And so the total work week pay now becomes $475 a week for that employee. So for some employers, this may not be a cost-effective method to keep them at the same rate of pay. So you have a less popular method with the employee is a decreased hourly rate of pay. So we can do the math and figure out exactly per week what the employee would be getting the same amount, but in an hourly standpoint, it would look like it is a different amount per hour. So using this same example, if we decrease the employee's hourly rate to $8.42 an hour, remember previously as an exempt it was $10. If he works 45 hours, that's 40 hours times $8.42 for $336.80. Also paid for the extra 5 hours of overtime that the employee worked for additional $63.15. So the total weekly pay now becomes the $399.95, which is really very close to the actual $400 a week as an exempt employee working 45 hours. Now, this may be a good approach for an employee that works a lot of consistent overtime. So if that is truly that, once we've done the evaluation of the typical work week, and that's what we've come up with, it, that overtime is very consistent, it'll be very smoothing from your financials in order to keep them in this method. It may be a little more challenging to sell to the employee as it looks like an hourly decrease in the amount of work they're doing. So this is where it will be important that we have effective communication and to have this approach and to be able to get buy-in with the employee on this approach. Now, you can also reclassify them as a salaried non-exempt employee. So the employer can pay a non-exempt employee a salary each week for a defined number of hours. So for in our same example, we want to pay the employee 45 hours at $400 of salary each week. Yes, we can do that. However, every hour over 40 that the employee works, they still will be required to be paid the overtime premium. Now, the 5 hours that are over 40 will only have to be paid at the halftime rate because the one-time rate of the regular was already paid in our first 45 hours for the $400 salary each week. So for an example, for the same employee that works 45 hours for $400 salary, for that $400, 45 hours a week, we would need to calculate what the regular hourly rate would be under that salary. And it's $400 divided by 45 for the $8.88 an hour is the regular rate. That's what the employee would be paid for the full 45 hours. What's left is the overtime portion, which is the last half portion for the remaining 5 hours. So because the regular rate is $8.88 an hour, they've already been paid $8.88 an hour for 45 hours. We just need to pay the remaining half rate of the 5 hours. So it's the 88, half of the 8.88 is $4.44 premium times the 5 hours, which includes $22.20 of additional overtime pay. So for this salaried employee working 45 hours, the actual gross pay for this employee would be $422.20. Now, how does that change? If we still have the same employee that has working 45 hours, we're paying for $400 salary. But this is a big week. We've got a lot of projects going on and the employee happens to work 50 hours this week. It'll change the calculations. We still follow the same process, but the numbers will change a little. The $400 that we've agreed to for salary for the 45 hours is now turned into $400 divided by the 50 hours that they've worked. So now the regular rate of pay to figure out is $8 an hour. That $8 an hour is the regular rate of pay up to 45 because that was our agreement. Now we're left with paying the half of overtime premium for hours 40 to 45 plus time and a half for the 46 to 50, which was not a part of our salaried agreement. 5 hours at the halftime rate that we owe is the $4 premium of $20 additional overtime premium pay, plus the $5 a rate at the time and a half rate at $12 an hour equals $60 of overtime premium pay. So the gross rate for this employee for working 50 hours is now $480 for the week. Looking at the previous one for a $400 salary week employee that works 45 hours, it's $422.20. 50 hours, $480 per week. When the employee is exempt, whether they're salary non-exempt or hourly non-exempt, they still must be tracking all of their hours, and they still must be paid a premium for the overtime for all those hours over 40. This method, because it's not an exempt position, does allow for the reduction of pay when the employee works less than the actual salaried amount. So if the employee that we agreed to for 45 hours really only worked 40 hours for that week, we can make adjustments and deductions of pay because there is no overtime exemption that we're in fear of losing. Now, this also does require good communication and explanation of employees. Offer letters and policies may need to be changed if this method is used so it's consistent with your handbook in the way you're describing overtime and salary and the actual way you're processing and you're actually performing the pay.
And Dave, I think, what kind of situation do you think makes the most sense to use that salary methodology? Give an example of maybe what would make sense.
So for this case here, when you're very consistent with the actual hours, you really want to stay with that method because for most times we already know, we've done the analysis that we would stay with that salary because the overtime is typically 45 hours. But this doesn't disallow for the fact when that project week comes up, we have a special thing that you have to do a recalculation of that method. You can't just stick with the same calculation over the 45. It's just an off time when it might be a little bit different from the norm.
So that may be harder to track if every week the overtime is different in every week. So that may not make the most sense for that type of position. That's
right. It would need to be calculated differently if it's a fluctuating, if it's not fluctuating, but it's a different overtime, it's not consistent
every week.
Every week. So the fourth option we have is to restructure workflow. And that really means of changing the way we're doing business and the efficiency or the processes that we're doing. Reallocating, hiring additional staff to reduce the amount of overtime hours that you might be required to pay and spreading that workload over more employees. This is one of my favorites. Bolster the exempt and duties of the remaining managers and heighten the expectations for exempt level managers. Need to do more, right? This method, though it's an option, it can get a little tricky and again would require some effective communication. And we can also evaluate the responsibilities that current exempt employees perform after hours. Checking the emails, returning phone calls, anything that's paid that we haven't normally had to track as an exempt employee, we'll want to make sure that we're tracking that time as when they become non-exempt employees. And then the fifth method we're going to talk about today is the fluctuating workweek method. So to use the fluctuating workweek method, 5 conditions have to apply. It is a little bit different in the way it's executed than the actual salaried non-exempt, but they are similar. For the fluctuating work week, the employee must work hours that fluctuate from week to week. So they can't be on a consistent same schedule every week of amount of hours. The employee must be paid a fixed salary that serves as a compensation for all the hours worked during that week. So in this case here, if we're out a day of that week, we only work 1 or 2 hours of that week. In the fluctuating work week method, you're still required to pay the full salary for that week. So even if the employee is out for any reason, that pay has to be made up. Now you can still supplement your pay as you do with vacation pay with being out and PTO time, but still in the event if they ran out of PTO time, they would still have to be required to pay the full agreed upon salary for that fluctuating work week. The third condition is no matter how many hours that employee might work in the week, it has to be sufficiently enough to cover the minimum wage, and that would be state-driven if you have a different rate. So in the event there happened to be an employee for 1 week needed to work in hours, 100 hours that week, it would be important that if that fluctuating work week salary that the employee had fell underneath 725, it would eliminate the use of the fluctuating work week method. So it's important to understand the maximum amount of hours that the employee can work, that they would still be paid that fluctuating work week and meet the minimum wage standard. The employee still must be paid an additional 1/2 of the regular rate for all the overtime hours worked. So this goes back to the whatever we agree to pay for that hours, the straight time that employee is getting for all the straight time hours worked in that week. And now all that's left is the half-time calculation of anything over 40, similar to the same calculation we did with the salaried non-exempt. And this is the most important one here that can really trip up employers is there must be a clear mutual understanding that the fixed salary is compensation for however many hours the employee works in a particular week. And one of the typical pitfalls of this one is the handbook explaining overtime and the employee being told something about the fluctuating work week, and there never was a real clear understanding of which the pay method was being used for the employee. So you may end up, again, having to go back to handbooks, policies, and offer letters and making sure they're consistent and clear mutual understanding of how this fluctuating work week is being processed. What are some of the benefits of the fluctuating work week? It does allow employers to pay part-time managers or administrative employees on a salary basis, even though there may be a overtime premium for it. Might be a good option for an employer with wildly fluctuating hours each week. So you're paying that smooth amount every week, no matter what the amount of hours that employee was working, and then only having to pay the smaller additional half premium for the overtime over 40. So it may help with your payroll being on a more consistent basis for cost. So it does allow the employer to retain one of the major benefits of paying a salary, meaning the predictable minimum fluctuation of the wage costs. Again, keeping that payroll cost smoothed out over weeks. This is not an option for all states. For example, California. And it may not be appropriate for all types of industries. So industries, for example, that may have premium pay for shifts might not be a good fit for this method. So before implementing the actual fluctuating workweek method, it's important to look at all the possible scenarios that may or may not apply with your state or your industry.
David, I can think of one client that we dealt with before that was a contractor, and they had a hard time hanging on to their employees because there were periods of time where the checks were really small, and then there were periods of time they were really busy working a lot of hours and their checks were really big. And so that fluctuating work week made a lot of sense for them, just to retain those employees, like you said, keeping their salary kind of, evened out throughout the course of the year. So maybe that's a good example of somebody where the fluctuating work week makes sense, not only to the company, but also to retain employees as well.
Yeah, there is a benefit to having that salary from an employee standpoint, that no matter consistently each week, I can at least count on this amount of salary coming in every week, even though it might be a slow period during that time. Absolutely. So when we're doing this, what are some of the practical considerations when we're making all these changes? Right? Employees will need to have a change in mindset of what becoming an hourly non-exempt employee means and what it doesn't mean. So there's going to have to be some good communication of now what it looks like and what the requirements are when it involves becoming a non-exempt employee. Status from exempt to non-exempt may be changed, but the duties may be the same. So here's a contrast. I'm doing the exact same thing, but now I'm considered as an hourly employee. And so there can be some difficulties accepting that change and looking like a demotion, even though you haven't actually physically done anything differently, but now I'm an hourly employee, and the only thing different is actually that I don't have the benefits of being an exempt salary employee. Employees should understand how they will now be paid for actual hours worked, that if they leave early or they're coming in late or they're working more than 40 hours in a work week, that this would adjust their pay. So based on the strategy the options that you've chosen to elect for your company, how we communicate this and how it impacts those non-exempt employees or their changes will need to take into consideration. And also by way of policy, understanding that employees need to be aware that any overtime must be authorized by a supervisor in advance. However, keep in mind that FLSA regulations require you pay overtime, and they put these words in specifically, whether they are suffered or permitted. So even if you have not permitted the employee to take the overtime, you've suffered it, you're still required as an employer to make those payments of overtime, even though the employee didn't follow the proper procedures. And then potentially this could be less predictable cash flow if you're trying to smooth out your payroll accounting. So how are the newly non-exempt employees going to be tracked their hours? Something they haven't had to do in the past, or it's been so long since they've had to do it. It's going to be, maybe it takes some retraining in order to take that. The employer does have the flexibility to determine what's the most convenient way for them. Do we go with a time card? Do we implement a time clock? Do we have a web option that we can use that the employee can do it while they're out in the field? So it's up to the employer ultimately to decide what they want to use that's most convenient for them. I will warn you, what happens a lot of times with this new transition is the fear of what we call in the payroll industry of the repeating eights, where the time clock turned in for a non-exempt employee is 8 hours on Monday, 8 hours on Tuesday, 8 hours on Wednesday, all the way to 40 hours. This will cause some problems in an auditing standpoint if that's actually the way the time's being recorded. So recording time from an actual in-out basis as a non-exempt employee is going to be beneficial when it comes to proving your overtime payment. As your PEOs, we certainly have a simple and inexpensive time clock solution that can be on-site or web-based. Please definitely contact your HR rep, and they can explain to you all the details of using some of our options from time clock and time recording. May need to find very specific timekeeping and time correction policies, making sure it's tracked appropriately, and how we make the corrections to those timekeeping. So if an employee does make an incorrect recording of time, it was not approved overtime, making sure that to make those corrections that we are making the payment on those and not actually altering pay cards or time in order to adjust because of their lack of getting the proper approval. So definitely now is the time to start cleaning up the classification problems the good news is we've been offered an extended amount of period up to December 1st to help us get in line. We were certainly fearful that the typical period allowed for this transition was going to be 60 days. So this is actually a blessing for us in order to give us a little more time to be able to thoroughly examine all of our exempt positions and non-exempt positions and making sure we are in compliance. And your PEO rep will be able to help you review those positions and help you to determine any exemption statuses that you may have. So what do I do now? Certainly contact your HR consultant. They can help you with identifying the potentially affected employees, discussing all these options that we've talked through today, maybe helping you decide the best options for your scenario and your company, and as needed, develop clearly worded overtime and timekeeping policies. It can also help you develop strategy and how to communicate these changes, help train the managers and what they now need to look for, and now what they may be responsible for as far as timekeeping may be required of them, and implementing a timekeeping software solution if that turns out to be a method choice. This time, we're going to open up the questions, and it looks like it will give a couple minutes to see if anyone would like to submit any questions. While we're waiting for any questions to come in, do want to remind you we do have a upcoming webinar in July, generating sales from the Southeastern Sales Consultants, and that's going to be in July 16th. Hopefully you will attend this session as our continued series. Remind you that all of this attendees today for today's presentation will be sent a copy of the presentation, so we have your email address from registration. We'll be sure to send these out at the conclusion of today's webcast. All right, so there's a good question that has come in about what is the chances of these administrative rulings being repealed. There is a chance. However, the process for which this would be, in order for it to be appealed, has really been diminished, especially when it comes to the Obama administration. In this case here, it would require an act of Congress, a law being passed. Right now, that would require an overruling, and there has never been an opportunity of a majority overturning this in the Obama administration. They would have to, they could repeal it, go through Congress, it'd have to be approved. The president could then veto the actual passing of the bill, and then it would have to go back to Congress for a 2/3 majority, and this has never happened. This is what's never happened, so they really don't see the success chances very likely of a 2/3 majority, as they feel that President Obama would certainly veto any opportunities to repeal it. Good question.
So I think the unfortunate news is we got to all be ready for December 1st for the changes.
Well, if you think of any questions after today, certainly get in touch with your HR rep. Oh, great.
Yep. So we got a question here. We've been counseled that farm workers do not have to be paid overtime over 40. And there are some very specific exemptions related to certain types of industry. Agricultural farming is one of those.
Transportation, DOT.
Yep. Right. And so those exemptions have not changed with these new regulations. So if you had a very unique exemption that you already enjoyed under the FLSA regs, that's not changing. So that's a good example of one, and we do have several clients that qualify, have individuals that qualify for that particular exemption, and that does not change. All right, David, I think those cover all the questions that we have.
Well, great. Thank you all again for attending today's webcast, and hopefully we look forward to seeing you again on our future webcasts. This concludes today's webcast. Enjoy the rest of your day.